Welcome to Kitco News. I'm Niels Christensen. We've seen cold wars, we've seen currency wars, and here to talk about the battle over the dominance of financial markets is Michael Howell, Managing Director at CrossBorder Capital and author of his new book, Capital Wars. Thank you very much for joining us today, Michael.
Great pleasure.
So in your book, you talk about the battle that's going on, specifically between the US and China for this reserve currency status. Do we need to be worried that the US is being challenged for its dominance in financial markets?
Short answer is yes. I mean, this is explicit Chinese policy. They've stated for several years now they would like to displace the US dollar as the primary currency of Asia. That's their goal. In order to get there, they've got to challenge US financial dominance. It's very clear.
What does this mean for market stability then? I mean, we've seen US reserve currency status since post-World War II. Are you expecting to see massive volatility? What are you looking for?
Well, I think that what we're likely to see is certainly, as you suggest, more volatility. I mean, that's got to come. We've seen many examples over the years, over the decades, of transitions between dominant currency zones, whether it be from sterling to the US dollar, whether it's been from in earlier times the Dutch guilder to sterling, etc. These transitions tend to be quite volatile and challenging for financial markets. Now, that's not to say that the existing regime that we've got is wholly stable. And I think the problem is that the world is outgrowing the dollar system. Or to maybe put it another way, China is leaning too heavily on the dollar system, and the dollar system can't really cope at the moment. And the issue really comes down to one whereby China is such a large economy, it is dominating world trade for sure. It uses dollars through its supply chains. And ultimately, what China needs to do in the longer term is to start exporting yuan and to stop re-exporting US dollars. And that will create more stability. Now, inevitably, what that will mean is a challenge to the dollar system. And that will not be a smooth transition. And as we're likely seeing at the moment, what you're getting is a transition to capital wars, whereby the US is resisting this challenge. And you will get the world effectively cleaved into two areas, a dollar zone and a nascent yuan zone. And I think that's what the COVID virus crisis is accelerating more than anything else.
You talk about this. This is what the book is about. Is this fight for reserve status and the two nations pitting themselves against each other. I'm sort of wondering though. I mean, like, capital markets are so huge. One of the criticisms that I've heard is that nothing will replace the U.S. dollar because there's nothing as liquid as the U.S. dollar. So I'm sort of wondering, I mean, what do you think are the chances of the U.S. losing its reserve currency status?
Well, I think look, in the short term, as you rightly say, it's very difficult for China to mount a challenge. But, as the old saying goes, every journey begins with one step. And what China is clearly doing is trying to make that step, and it's trying to walk down the road whereby the yuan becomes a challenger currency to the US dollar. Now, given the fact that China is already the world's largest mercantilist economy, in other words, the biggest exporter and the biggest importer, for the most part, it is invoicing those goods in US dollar terms. The US dollar, as we know, is used very widely through Chinese-led supply chains. Now, all China needs to do is to start invoicing more product in yuan. And that would give scope for Chinese banks to develop a trade credit market. China then would need to open up its bond markets, which are for the most part domestic, attracts domestic savings at the moment, to get foreigners into that market. And maybe as a third leg to establish a digital yuan that can be used in terms of peer-to-peer transfers across the Asian region. Now, in all of those three examples, China is actually beginning that process. And if you want a historical analogy, let's go right back to the beginning of World War I. In 1913, the US dollar was quoted in fewer markets than the Austro-Hungarian krona. By 1925, when sterling came back onto the gold standard, bearing in mind that the US dollar had been nowhere 10 years earlier, sterling was quoted against the US dollar in 1925. That's when it came back at $4.86 to the pound. And that was the benchmark that was used. So from nowhere, the US dollar had basically climbed into becoming the dominant currency in the world economy. Now, what was the trigger for that? The trigger was that the Federal Reserve had been established in 1913, and basically US banks were allowed to, or increasingly took on, the trade credit role. More and more goods, particularly through World War I and US supplies to Europe, were being priced in US dollars. And that was the catalyst. Now, if you look at the same path, China could very much do the same thing right now. And if you look at the establishment of a central bank, although we know the People's Bank has been in existence for a long time, it's been part of the Chinese framework, in reality, the People's Bank has only really been operating in a way that we would call a central bank since about 2015, so very recently. PBOC watching has got to be a skill that analysts take on from now.
You mentioned that COVID-19 is really widening this gap. Could this be the spark for a new reserve currency similar to what we saw in World War I? Or does something more drastic have to happen to really accelerate this issue?
There are a number of criteria that are really required for reserve currency status globally. One is a large economy. America ticks that box. China ticks that box. The second is military presence, or the ability to conduct military operations and to have geopolitical strength. The US has definitely got that. China, that's more of a question mark. So it is fiscal stability. China has that. The US probably, but one would have to say that there is a question mark which is growing larger following the COVID virus crisis. Is the US in such a strong fiscal position as it was only 2 months ago? That's clearly a question of some debate. And then the third aspect, which you alluded to earlier on, is depth of liquidity in their financial markets. America definitely has that without any question. China does not. And that is the clear gap. So if China wants to challenge the US, it's got to develop its financial markets. Financialization is the key to progress in terms of China's reserve currency. And the three factors that I alluded to, opening up the bond market, developing a trade credit market in yuan through the Chinese banks, and establishing a digital yuan, are three, I think, necessary and possibly sufficient conditions for the yuan to be a challenger. It will not be overnight, but journeys begin with one step, and we're looking at maybe a 10-year journey. Now, I think what the COVID virus crisis has done is to accelerate these trends, and whereas the establishment of the yuan, which I would have said 3-4 months ago, may be at least 10 years away, I think it could be as early as 5 years away.
I think one of the things that I was reading the synopsis of your book, and one of the things that popped out at me is low interest rates can really hurt liquidity in markets. And right now, that's what is needed to fight sort of this reserve currency status is liquidity. So I'm wondering, with the Federal Reserve at the zero bound target, is there issues of a liquidity crisis in the market then?
Yes, there are. I mean, this is a sort of becoming a perennial problem, and it's largely because the central banks have screwed up in many ways in terms of their policy responses. And if you look at effectively what happened after GFC1, the 2008-2009 crisis, the policy that was enacted was low interest rates and austerity. In other words, to contain fiscal spending. Now, the problem with that particular policy, Nick, number one, it forced the private sector into deficit. And secondly, low interest rates encouraged the private sector to borrow. So it's no great surprise, I would say. It's not rocket science to say that what you're going to see here is an escalation of private sector debt. That is precisely what we've seen. So global debt levels now have escalated to levels of over $300 trillion. Now, if you look at the math behind that debt burden, financial markets, contrary to what the textbooks tell us, are not simply new financing mechanisms. In fact, in truth, they've not really acted as new financial mechanisms for some considerable time. They are refinancing mechanisms where debt is primarily rolled over.
Now, if you've got a 300 trillion stack of debt to refinance, what that means effectively, assuming a 5-year maturity, is something like $60 trillion of debt that has to be rolled over every year. Now, to do that, you need balance sheet capacity. You need to have liquidity in the markets. And that's what the central banks ultimately have to create. And ultimately, what you've seen in recent years is actually low liquidity levels, or they've been bursts or periodic spurts of liquidity. And then the central banks have gone back to tighten liquidity once again. So you've seen a series of QE processes, QE 1, 2, 3, 4. We suggested back in 2008, the policy response would see these various QE processes rather like popping pills. Now, we thought you might get up to 6. I think now you're likely to get QE 10, 12, or whatever. The policy has been whenever there is a liquidity shortage, central banks come in and add liquidity. And that's what we're seeing now, en masse. The amounts of liquidity they're having to add are just awesome. And what that means is it's a green light for gold.
Like, I think now we can sort of talk about QE affinity. I don't think it's going away. And interesting, you bring me to my final question. What role does gold play in this? I mean, is gold going to be an important asset in this fight for dominance in financial markets?
I mean, the fact is that what we know is that governments will try and demonetize gold, but they can never succeed in doing that. Gold is out there. And what you've got now is a challenge between different currency systems. Inevitably, there'll be volatility. If you want to diversify your currencies outside of the US dollar, how can you really do that? There's not the depth in other markets. There's question marks over the status of the euro. I think, well-founded concerns about the euro. And therefore, gold must be the alternative asset. Now, it's also true that, let's say adversary economies like China and Russia already realize that. They've been accumulating the large stocks of gold themselves. And I think I'm correct in saying, but I'm sure you or your viewers will correct me, that something like 15% of the total stock of official reserves are now held by China and Russia alone. They're starting to build this up from ground zero at a very rapid rate. And therefore, gold, I think, is an asset where you've got to start thinking about it seriously as a fundamental part of any investment portfolio. Gold is going up, we think, by quite a lot. And if you look at the scale of this monetary infusion, it's clearly backing gold, pushing the price of gold up.
Well, it feels like, as big as the gold market is, it's still, it's still small compared to global assets. So it feels like the price does have to go up just to meet this global demand.
I think absolutely right. Absolutely right. Another measure of how much gold could go up is basically to say, well, okay, if you look at the stock of debt, outstanding debt in the US economy alone, and take that as a share of relative to GDP, we know that percentage has gone up remorselessly over time. But the other way to value it is to look at it in terms of gold value. What is the true gold value of that debt stock? And that gives you another measure of the real economic cost of paying that back. Now, if you then equated the total pool of debt to the total stock of gold, and you said, what's the equilibrium to get us back in terms of historical averages, the gold price today would have to at least double, if not triple.
Thank you very much for this conversation, Micah. It's been a fascinating conversation. So again, thank you for your time.
Pleasure. Great pleasure. Thanks again.
Thank you for watching Kitco News. For the latest in the precious metals markets, go to kitco.com. Stay safe and stay healthy.